Hey everybody, Courtney Smith here, and in this video, I'm going to tell you how the Fed is going to disrupt major markets around the world. Now, why am I doing this? It's very simple. Number one, I want to know what's going to happen for the rest of 2023 so I can maximize my trades to maximize my profits. So that's the key reason why I want to do it. But there's a second one that's more subtle, and that is that by creating a hypothesis, I can continually test and retest that hypothesis during the year. So if the hypothesis turns out to be a little wrong, I can create a new hypothesis and get back on track. By getting back on track, that gets me back to the very first reason. It helps me maximize my profits trading. All right, hang on. Let's get going right now. Hey everybody, Courtney Smith here. Let's talk about how the Fed will disrupt the markets in 2023 and how you can make money from this disruption. Let's get going here, shall we? So why are we doing this? Well, this is the first in a series of videos where I'm going to be breaking down 2023 and what's going to happen to it. I did a great job last year. I hope to do a good job this year. But we're going to have videos on the stock market, bonds, gold, the dollar, you name it. We're going to talk about it and what my overall strategy is going to be. So what we want to do is we want to understand what will happen in 2023 so we can maximize our investing profits. Now, we can also create a hypothesis of what is going to happen so we can continually test and retest the hypothesis. Why? Because then we go back to number one. What will happen? If we test the hypothesis and it's working great, we continue with the hypothesis and we maximize our investing profits. If the hypothesis is wrong or needs to be changed a little bit, then we change it a little bit. So once again, we can maximize our investing profits. So let's talk about the motivations. Motivations are one of the most critical ways to analyze a market. What are the motivations of the players in the market? And in this case, we're going to focus on just the Fed. We'll talk about fiscal policy in a future video. So, of course, subscribe, etc., etc. So what does the Fed want to do? Well, what they want to do is they want to get CPI below 3%. Their target is 2%, but I think they'll be happy if they can get it below 3%. Now, we were at 9% on CPI very recently. Now we're in the low 7% area. So they've started to talk about how they're not going to tighten so much in the future. So the market is rallying on the basis that the Fed is not going to tighten in the near future. They also don't want to cause a recession. Okay? Now remember that the Fed are all academics. They're all left-wing, so they are very labor conscious. And they do not want to have a recession because that would hurt the labor market. So they're going to be watching labor statistics very, very closely. Now, I look at this and I say, can't be done. Either you get CPI below 3% or you cause a recession. I mean, they're gonna, if they get CPI below 3%, it causes a recession. If it doesn't cause a recession, they're not below 3%. Okay, so they're between a really, really big rock and a really, really hard place. So why can't the Fed get that? Why can't we have inflation below 3% and no recession? So let's take a look. It's too late. They already screwed it up. They created the conditions, and I'll show you how they did that in just a minute. They already created the conditions for massive inflation. Inflation that's going to remain too high for far too long. Even with a recession, it would be hard to get inflation below 3% or 2% or whatever it is. You see, the problem is that we now have a Fed, and we've had a Fed now for about 10 years, that has no people who've ever had a real job. They're all academics. And as a result, they don't relate to reality the way the Fed used to. Now, the Fed was crap before, and they're crap now. It's just a different type of crap. But they used to have bankers and industrialists on the Fed, usually as a minority, but nonetheless, they could provide some real-world experience of how the world really works. But now you have nothing but academics with no real-world experience, and they screw it up all the time. They have the worst predicting track record of any economist in history. That's proof positive. You can find it on the internet. So they've already screwed it up, and that's a real problem, because how do they get back to a normal situation of low inflation and a strong economy? We'll talk about that in a minute. So this is a problem. They have wrong theories of what causes the market to actually move. They have wrong theories about what causes inflation and what doesn't cause inflation. So let's take a look how they screwed it up. This is M1 money stock. And you can see, if I change the scale, some of these movements here might seem really big, but as you can see, starting in 2008 recession, the line accelerated significantly. Before, it was almost flat, going back to 1960. And then came the recent explosion. And here you can see that the money supply went from like 1.2 trillion to over, like, let's call it 7.2 trillion. So money supply went up 6 times. And this is what's called powerful money, because it's M1. And I've deducted inflation. Otherwise, it would look even worse. So when you have a gigantic increase in money supply, it's got to go somewhere. Now, one of the places that it went to, which was caused by the Fed, was we had bubbles. Yes, the world became bubblicious. We had a bubble in the stock market. We had a bubble in crypto. We had a bubble in bonds. We had a bubble in real estate. And now that the Fed, you can see money supply is actually shrinking now, all those bubbles burst. All of them. And some of them are still bursting. The real estate market has yet to hit bottom. I don't think crypto has hit bottom. I think bonds and stocks have hit bottom at this point. But once again, we'll talk about those in future videos. But so here what we can see is, people say, well, how is this, why does this cause inflation? Well, let me give a simple example. Let's say there's only 2 things in society, only 2 goods. You can only buy 2 things, bread and bologna. That's it, okay? And let's say a loaf of bread costs $1, and let's say that bologna costs $1 per package, okay? Now, the money supply, there's only $2 in circulation. So the price is very stable. It never changes. Now, let's say the Fed were all of a sudden to double the money supply. And remember, here they boosted it 6 times. If the money supply were to double and go from $2 to $4, what would the price of bread and bologna go to? That's right, they would double. Now, did the value of bologna and bread change? No, not at all. But the price did. And because the quantity of money doubled, the value of each dollar was cut in half. So I need you to stop and think about this. If we sextuple the money supply, the value of money is cut by 82%. Okay? That's called inflation. We don't call it depreciation of the money, although that's what it really is. The Fed has degraded the value of the money massively. And so the only way that they can get the value of money to come back into line is to reduce the money supply, which is exactly what they're doing. And they do that through raising interest rates. So the demand for money goes down because they've increased the cost of money. But that money's still there in the economy. Now, we've had trillions of dollars wiped out because of the stock market. We've had trillions of dollars wiped out because of the crypto collapse. We're having trillions of dollars eliminated from the housing market. We've had trillions of dollars eliminated from the bond market. I mean, I could go on. There's lots of other bubbles, but those are four major ones. And so what's happening is that the Fed has already created the inflationary boom. And yes, a lot of that money went into those speculative assets, but a lot of it went into the real economy, called gasoline, called bread and bologna, okay? Rental prices, etc., labor prices, the price of labor, all of these things are going up now because of this, the world's largest increase in money supply in history in any country. That's how, I call it the drunken sailor monetary policy. Drunken sailors on shore leave, okay? Now, here's a real money. What I've done is just taken I've taken this chart, only now we're just going to look at the last few years, okay? So let's look at it more closely. So here's 2008, and this is where the money supply started to really go up. And I thought it was going up at a dramatic pace, okay? Dramatic pace. But no, they jacked it up theoretically because of COVID. They kept jacking it up, although at a slower rate, and now they're slowly reducing it. But how could the money retain its value until this number were to get down to, say, here? Okay, it doesn't have to go all the way down to here, but it's got to be down here somewhere. Is that likely? If that were to happen, we would have a major depression. So I don't think that's likely at all. I don't think they're going to let money supply drop that much. Now here's CPI. And I wanted to give you some perspective. So I've gone back into the 1950s to show you where we have been. Now, I started my trading career right around in here, around 1970, 71, right in this career. And I went to Wall Street and became a professional over here at the peak of the market, 1980. And we had a gigantic collapse in inflation. And here we are up around 13, 14%. And we got it all the way down to about 3%. That was Paul Volcker's crushing of the money supply. But notice we had two recessions here. Two recessions, a short one and then a major one. Okay? I want to show you one other thing, because this is what I think the Fed is going to do. If you look right here, Volcker comes in and he slams on the money brakes. I mean, he's in a Ferrari going 200 miles an hour, and what does he do? He slams on the brakes, pulls on the parking brakes, and pops off the wheels, and the economy and inflation come to a screaming halt. And oh, by the way, he runs into a wall. But then he flinches. Right here, he flinches. Things are going great. Things are going great. So he flinches and takes his foot off the brake pedal, and the inflation starts to come back. And then he says, oh my God. And this is called the Volcker mistake. The Volcker mistake. And by him just pausing, it caused inflation to skyrocket again. And then he had to really put on the brakes. And that's what really caused this big recession here. Okay, the Fed's going to do the same thing. These guys can't learn from their mistakes. They're always fighting the last war. So what we're going to do is, the Fed has come out. We've got this big increase in inflation from like 2% up to, as I say, we got over 9% on an annual basis. But even here, this is, by the way, less food and energy. Including food and energy, it got up to 9%. But this is core inflation. Core inflation. And it's over 7.5%. Let's call it 7.5%. Okay? Each month is slightly different, but roughly. Now notice how it's paused. Notice how we're kind of going sideways. And this is being caused by the Fed saying, we're getting close to the end. Oh, we don't have to be quite so aggressive. We're not going to raise 0.75%. We're only going to raise 0.5%. In other words, he's already starting the Volcker mistake. So once they stop the tightening, and that'll be probably around March of this year, maybe they'll do one more 50 basis point increase, then maybe a couple of 25s just to show how strong they are in the fight against inflation. And then it'll pause, and they will stop doing anything for months on end. probably 3 to 6 months, they will do nothing, leave it roughly the same. They're going to pause to see what's going on in the market, to see if it helps. And during that time, they will be repeating the Volcker mistake, and inflation will start to rebound, start to move up again, and they will freak out. So I wanted to show you in perspective where we are. And this is the highest inflation since the glory years of Paul Volcker. And I remember them extremely well because I was an institutional trader at the time, working for major banks, head of research at 2 brokerage houses, et cetera, et cetera. So I was deep into the institutional world all day long. Now over here, we have a different index. And all these charts are from the Federal Reserve Bank of St. Louis, which does an excellent job. They have a database called Fred, as you can see up in the upper left-hand corner. And if you search on Fred, you can find it. And it's all free. So now what we're talking about, one of the reasons why inflation is not going to come down the way they think is because inflation isn't a monolithic number. The first thing that moves are things like food and energy, commodities. They're very sensitive to monetary policy, and as a result, they tend to be the first things that move in an inflationary or deflationary cycle. Following that comes what are called the sticky prices, and that would be things like rent. Rent lags. The landlord starts to get squeezed because the cost of his electricity and maintenance is going up, etc. His interest rate on his mortgage is going up, and so he starts to raise his rents. But that's like a year after the cycle starts. Another big sticky one is labor prices, and labor prices are a lagging indicator of the economy. So right now we have wages, nominal wages without taking out inflation, going up. And this this chart here shows nominal sticky prices. So sticky prices are prices that don't come down very quickly. It might take a year or two for them to go up. It might take a year or two for them to come down. Whereas food and energy can go up one month and down the next month. Here you can see that we have over doubled sticky prices, and sticky prices are now up around in the high 6 area, just under 7%, and that's a real hike from the 2% where we were 8 months ago. So they've tripled, and we're just beginning the cycle here. This is going to continue to move higher. We're going to see sticky prices above 7.5% in the first quarter of next year. And so when the Fed is trying to get prices to come down, yes, you know, the headline prices have come down from low 9s into the low 7s, but that's all because of food and energy. Here's the core. Here's the sticky stuff. And this doesn't come down anytime soon, and it's up around 7%. So the Fed it'll take a year or more to get this index to start to come down. All right, notice the Volcker mistake over here again, same thing. And sticky prices here, look at this. They started down here years from each low to a high. Here, this one was pretty fast. Only took a couple years to get to the high and then it came down. But we had to have a recession to kill the labor market. Well, wait a minute. Recession? Kill the labor market? The Fed doesn't want that, which is why they will repeat the Volcker mistake. They will ease too quickly. Now, another big problem that exacerbated, but did not cause it. People are talking about, well, inflation was caused by the war in Ukraine. Not at all. Not at all. Remember what I said. If I got bologna and bread and there's $2 in society, if the Fed had never raised interest rates, we can have a war in Ukraine and it can be deflationary if they don't monetize the war. But of course, they've monetized it, mainly COVID. They didn't really monetize the war. But the other problem, too, was the federal government, which you can see, this chart goes back to 1900, okay, just to put it in perspective. So we had a little teeny budget deficit here. It was only caused by a major World War II. And then we started the profligate spending, the drunken sailor fiscal policy. We started it here in the early 1970s. This was a big reason what caused the stagflation of the 1970s. We actually had a little bit of a rally up here, got into a surplus because of tax revenues, and we've been plunging ever since. Here's the 2008 federal budget deficit. We rallied a bit there. And then the COVID budget deficit reached phenomenal lows here. But because tax revenues are skyrocketing and the federal government isn't spending as much, we're seeing a sharp rally. So it's still a monster deficit. Look at this. We're still not back to the level of the low of 2008. That's how what drunken sailors our Congress people are. But nonetheless, a little known fact is budget deficits, increasing budget deficits are bullish for the stock market. This is one of the reasons why I was bearish this year. All right? And it's still a bearish factor. So when the federal government starts to spend trillions of dollars, that boosts demand as well. Now, that demand is shrinking at the same time that we're seeing the Fed tighten money supply. So all of that is deflationary and will cause inflation to come down. But as I showed you, they put too much money in and the sticky prices are still going up. Okay, here's what's going to happen. They will reduce money supply and they will raise interest rates. And they're doing it right now. And that will reduce, and I don't really like to say eliminate inflation, but we could get down to 3%. That's possible. But it will cause a recession and probably a bad recession. The Bank of England came out with their projection and they said that England is going to go into the longest recession in history in the UK. 2 years long. That's really what's going to happen here, I think. We're going to have a recession. It's probably going to be a bad recession, but if it's not a bad recession, that's good news. The bad news is it will be a long recession. So it's either we want, in a way, it's hard to say which we want. A bad recession usually means it recovers quickly. But the 2008 recession was actually not, it was the Great Recession, but it lasted longer. The recovery was very slow. And I think this one's going to be a slow and bad recession, which is, I don't want that. I don't want anybody to suffer. But the Fed caused this problem. Not Putin and not COVID. The Fed. Thank you, generous Jerome Powell. So here's what the Fed will do. Now follow along, get out a piece of paper and write this down because it starts to get complicated. They're going to keep raising interest rates to a terminal rate close to 6%. Now right now the market's looking for maybe 5.25. I think they're going to go a little bit further. They might do it by quarters and halves. But I think they're going to raise a little bit faster because inflation, they'll start looking at the core inflation that I showed you and sticky inflation, which is still going up. They'll look at the labor market. The labor market remains apparently strong. And so they will probably raise it a little bit further than expected. But this will help reduce inflation to below 5%. So the Fed, if they get it down below 5, and like I say, we're up around 7-ish now, a little above 7 right now, that'll help reduce inflation to below 5%. Do I think it's going to go below 3? No, I don't think so. Those sticky rates are still too high. There's still trillions of excess dollars in the market. So we're going to help reduce inflation to below 5%. And so the Fed, they can say, God, we went from 9% to 5%. So the Fed will signal they're through tightening. Now, this is the phase where I think we're going to see Fed funds very stable. 3 months, 4 months, 5 months, 6 months, no change at all. And so, but that signals to the market that the next move is lower interest rates. And that's going to cause inflation to drift higher. Raw material prices, the sticky inflation figures will still be high. They'll still be at 7%. Maybe they'll be at 6%. But then the raw material, the sensitive factors, the ones that are sensitive to Fed policy, they'll start to spring up again and inflation will start to drift higher. Now, what I just described is the Volcker mistake. And the economy will be in a recession, and that will cause the Fed to not ease, thus causing governments to ease a fiscal policy, because now, if we're in a recession, they're going to have to start paying more unemployment. You're going to start seeing the federal government, well, we have to have the Help American Out Act, and here's $2 trillion to help Americans out. We're going to stop student loans. We're going to stop we're going to put out more PPP loans like we did in COVID. That worked great. And we're going to see the federal government start to pump out trillions of new dollars. Thus, that's another factor that will cause inflation to drift even higher. Now, follow this sequence along. Now, by the time we get here to causing governments to ease fiscal policy, we're going to be in probably the second or third quarter of 2023. Eventually, the economy will be in a severe recession, and the Fed will ease. Now, in effect, this is going to be another Volcker mistake. But the current makeup of the Fed is far more interested in economic growth than they are in inflation. So they will create another massive stagflation. The 1970s was like 5, 6, 7, 8, almost 10 years of stagflation. We might be going into the same situation now. I'm working on a book right now about stagflation because there's really no books about it. So we need a book about stagflation and how to make money at it over the long run. So the Fed will ease. Now, all of this is going to happen next year in 2023. This is a major thing. But notice the Fed is going to be herky-jerky. They're going to signal they're through. When they say they're signaling that they're through tightening, that's effectively an easing. Then the recession, they're not going to ease. Then they're going to ease fiscal policy. So we're going to see several very major changes in Fed and fiscal policy. They're going to cause markets to be very volatile next year. Now, let's carry on. So how do we make money in all this? That's the real reason you're watching this video. And frankly, I'm a professional trader, so I do all this analysis simply so I can keep on being a professional trader. So how do we make money? Well, the environment is going to be stagflation. What is stagflation? Stagflation is a stagnant economy combined with inflation. Now, a stagflation would not include a bad recession, but it could include a mild recession or growth under 2% and definitely under 1%. But let's just call it somewhere between plus or minus 2% would be stagflation. That's going to be the major environment that we're in 2023. And this is an environment we have not invested in since the 1970s. So time to dust off your economic history books. I know it's a favorite thing for you to do on a Saturday night, and start reading about the 1970s. So let's go through some of the major asset classes and talk about our overall general strategy. Right now, as I'm recording this, I'm long stocks. Not heavily, but I am long stocks. Why? Because I think that the Fed's next move is towards easing. It may be, I shouldn't say easing, but effectively easing, which is if they stop raising interest rates or if they slow the raise in interest rates, that's effectively easing. And that is very bullish for the stock market. In addition, when we are going into an earnings recession, but actually we're almost to the point where the earnings recession is so bad, it's a buy signal. Another thing is that seasonally, 2023, a pre-election year, is the best seasonal year of the 4-year presidential cycle. It's nearly always a bull market. Nearly always a bull market. So we have a number of reasons to believe that, generally speaking, the environment is going to be bullish for 2023. But because of the volatility, I think there's going to be times, I don't know that we're ever going to go short the market again, but we may get down to all cash or very little investments and maybe even some short sales. We have to be open to that possibility, particularly later in the year. I think the Fed, they may start to tighten again, once again, the Volcker mistake, and that will cause the market to tumble maybe as much as 10% during the year. So we have to be very, very nimble. We don't want to just buy and hold. That would be idiotic. Bonds, I can make a case that bonds will go into a bear market. Again, we're in a little bit of a bull market here, but I've been short bonds the whole year and have no position right now. And if and with the recession coming, I think that's bullish for bonds, but the threat of more Fed tightening is bearish for bonds. So I'm going to avoid bonds this year. If anything, I would probably be bullish because of the recession. The dollar, because the question is when you look at the dollar, you don't look at the Fed, you look at the Fed versus other central banks. And the US right now, the Fed has been the toughest on inflation and has had the tightest monetary policy for basically all of 2022. Right now, they don't. The market believes that, for example, the European Central Bank is going to be tighter. Bank of England is going to be tighter, and maybe even now the Bank of Japan will be tighter. But that negative comparison for the dollar is going to reverse. And I think it's going to be in January or February, we'll start to see those other country central banks flinch, and they will avoid tightening any further. And so the Fed will go back into being the tightest monetary policy. Now, they may not be tightening, they may be stable, but that will be assumed to be stronger, that other countries will ease sooner than the Fed. Commodities, a recession is very bearish for commodities. So I think generally speaking, we're going to be short commodities early in the year until the Fed actually does the Volcker mistake and starts to ease again, and then that'll spark a major, major rally in commodities. But that won't happen until the second quarter, maybe the third quarter of the year. So generally speaking, right now at the beginning of 2023, we need to be short commodity prices. And when I say commodities, that's also gold. That's also gold. Because if the Fed is still tightening and inflation's going down, that means real interest rates are going up. And that's the most bearish thing for gold there is. Okay, so let's talk about some next steps. What should you be doing going forward? I think the first thing is watch the rest of the videos in this series. I've just given you a high-level overview. I've gone into detail on the Fed, but only a high-level overview of how to make money. The other videos, most of the other videos in this series are going to be about how to make money. And I'm going to go into much more detail, analyzing these markets and where they are right now and how to play them, what specific things we need to do to make money. So make sure you click the notify, subscribe, do all of those sorts of things. Look for notifications on more videos in this series. That'll be over the next 2 weeks, so do all those things. I figure it'll take me about 2 weeks to do all of these videos, maybe one every couple of days. Now, we need to be nimble. I think 2023 is going to be a trader's market, not an investor's market. Late in the year, if we get into a really bad recession, then that'll turn it into an investor's market, because then we can buy. If we get into a bad recession, not a mild recession, but a bad recession, I'm licking my chops, because that means that stocks will become very cheap and 2024 will become a tremendous bull market. Right now, I think 2023 is actually going to be pretty bullish, but with some hiccups. But I really want a bad recession as an investor, but I don't want a recession because I don't want people to be hurt. Okay. Now, use the information in this video and in this series to create more freedom for yourself. Making money in the market is the only way you can build wealth. When you look at the top 30 wealthiest people, they all got rich by investing. Yes, okay, there's a couple of people in the Walton family that inherited, but I don't have that choice anymore, okay? I'm not going to inherit any money. So you need to use your money to make money. This is how wealthy people get wealthy. It's not by getting a higher wage. Yes, you can be well off and be very well off with a high wage. And that's great. You should always try for a high wage. But you can't get rich. And getting rich is how you create total financial freedom for yourself. So use this information to create that freedom for yourself. Remember, happiness is a choice. You don't, after watching this video, you don't get to come back next year and say, oh, I didn't make any money in the market. What are you talking about? You don't get to complain. You had the opportunity. So make a choice, and make that choice to have more happiness, more freedom, more happiness, more wealth. Wealth is not important, but wealth is important if you want more freedom for yourself. And the old saying is money doesn't buy happiness, but the counter argument is yes, but you can rent it. So happiness is a choice. Don't make the mistake of making the wrong choice. It's up to you. I also suggest that you go to CourtneySmithBlog.com. I probably put out 1 to 3 new articles of analysis there every single day. Best way to keep on top of what I'm doing. Register. And that way you'll get a notification every time I post something. Registering is free. Yes, you can buy higher tiers, but just go there to register so you get notifications of all the new content. It's really going to help out your investing. No hype. I'm just a calm, logical analysis. And that's what you really need to do.